Well, hello everyone and welcome to Momentum channel. Today we're going to be talking about 5 high quality dividend paying stocks that are considered very fast dividend growers. These dividend stocks are considered undervalued or reasonably valued at this time. Let's get into it. Our very first pick is a company called Canadian Natural. It's a Canadian business in the energy sector, which is also available for investors in the US with ticker symbol CNQ. The dividend yield for Canadian Natural currently is at 4.52%, and it is considered to be undervalued with a price to earnings ratio of only 5.5, which is below their own 5-year average. From a dividend safety perspective, Canadian Natural has a dividend safety score of 70, marking it as a safe dividend payer. They last increased their dividends by a whopping 28% back in March of 2022, which indicates a very fast dividend growth. In fact, over the past 5 years, on average, they've increased their dividend by 16% per year. And over the past 20 years, they've increased it by average of 20% per year, all of which suggesting to a very fast dividend growth. In terms of their dividend growth streak, the Canadian Natural has been increasing its dividend uninterrupted for the past 20 years straight. They do pay the dividend quarterly in the months of January, April, July, and October. Looking at the past performance of Canadian Natural Resources Limited, in the past 1 year, this stock is up by a massive 56.5%. In the past 5 years, this stock is showing to be up by 62% plus. In the past 10 years, it is up by 68%. And if you look at the longer time horizon, in fact, as far back as 2003, in this case, the stock is showing to be up by a massive 1200% plus. Just incredible return. Our second pick here is another Canadian business, as Toronto Dominion Bank, which is also available for US dollar investors with ticker symbol TD through New York Stock Exchange. It is as well considered an undervalued business with a price to earnings ratio of 9.9, which is in line with their own 5-year average. Toronto Dominion Bank currently has a dividend yield of 4.26% and a dividend safety score of 80. They last increased their dividend back in December of 2021, where they increased it by 13%. Looking at the longer time horizon, in the past 5 years, the Toronto Dominion Bank has increased its dividend by 8% annually, and over the past 20 years, they've increased it by 9% annually. They have a dividend increase streak of 11 years, and they currently do pay their dividend quarterly in the months of January, April, July, and October. In the 1 year, return for the stock is down by about 2%. However, the 5-year return is showing to be up cumulative by 28.7%. 10-year return is showing a nice 63% plus return. And if you look at the longer time horizon, going as far back as 1996, you're looking at a cumulative return of close to 1200%. Our third pick is another financials business. It's Principal Financial, with ticker symbol PFG. It's an American business which is considered to be reasonable value at this time at a dividend yield of 3.76%. It has a price to earnings ratio of 11, which is above their own 5-year average. However, they have a dividend safety score of 72, marking the safe dividend pair. Principal Financial last increased their dividend back in the year of 2020 to 2021 by 9%. They have a dividend growth streak of 13 years. Over the span of the past 5 years, they've increased their dividend by an average of 9% per year. Principal Financial does pay its dividend in the months of March, June, September, and December. Looking at the stock return for Principal Financial, the 1-year return is up by 8%. 5-year return for this stock is showing a cumulative 1.5% return, and the 10-year return is showing a whopping 159.4%. If you look at longer term horizon, again, you're looking as far back as 2001, and since then, you're looking at a cumulative return of 215% return. Our fourth pick is a healthcare sector business, Amgen, with ticker symbol AMGN. It is considered to be reasonably valued at this time, and it has a dividend yield of 3.14%. In terms of the price to earnings ratio for Amgen, we are looking at a ratio of 14, which is in line with its own 5-year average. Dividend safety score for Amgen is at 74, making it a safe dividend payer, and they last increased their dividend back in December of 21, whereby they increased it by 10%. Looking at the longer term horizon, in the past 5 years, Amgen has been increasing its dividend by 12% annually. In terms of their dividend growth streak, Amgen has been increasing its dividend for the past 10 years straight, and they do currently pay their dividend in the months of March, June, September, and December. Looking at the stock return, 1 year return for Amgen is positive 1.25%. The 5 year return is showing to be up by 42% plus. 10-year return of positive 198.7, close to 200% return. And the longer term horizon, if you look at it since 1992, close to that 30-year time horizon, you're looking at the whopping 2,970% return. Just incredible return over the span of the past 30 years. Lastly, our fifth and final stock pick here is Bristol Myers, another healthcare business with ticker symbol BMY, which is reasonably valued at this time. It has a dividend yield of 2.96%. And in terms of the price to earnings ratio, it has a multiple of 9.5, which is in line with its own 5-year average. Bristol Myers has a dividend safety score of 79, marking it a safe dividend payer. And they last increased their dividend back in December of 2021, whereby they increased it by 10%. Looking at the longer term horizon, in the past 5 years, historically, they have increased their dividend by 6% annually. And in the past 20 years, they've increased it by 3% annually. Bristol Myers has been paying and increasing its dividend for the past 15 years straight. And they do currently pay their dividend in the months of February, May, August, and November. What it means is that of all these 5 stock picks that we've talked about, if you have them, all of them in your basket, you have dividend income coming to your stock investment portfolio in every single month, given that their payment schedules fall into on different months. You have a coverage for January, February, and March, and they repeat that pattern from there onwards. Let's take a look at Bristol Myers past stock return. The 1-year return for the stock is up by 5% plus, 5-year return of 30% plus, and 10-year return of 130%. If you look at longer term horizon, over the past 30 years, this stock is up by 343.9, close to 344% return over the past 30-year time frame. There you have it, folks. A quick look into 5 high-quality dividend-paying stocks that are undervalued or reasonably valued at this time and have been considered to be fast dividend growers. I hope you found this video beneficial and gained something of value from it. If you did, don't forget to smash that like button and subscribe to our channel. Here on Moementum Finance, we post every week several videos about investing, including investing in dividend stocks, growth stocks, penny stocks, and crypto. We also talk about ways to reach financial freedom. Thank you, and I hope to see you next time.